everybody and their brother is going after these value-add properties. It's a lucrative strategy. It's really competitive to go after, and there's so many investors going after the same kind of asset.
Welcome to the Freedom Point Real Estate Podcast, where we talk about creating more time freedom through passive real estate investing. Passive investing in real estate challenges conventional investment wisdom. We are passionate about learning and sharing resources with others who are ready to transform their investing mindset. Quick disclaimer as always, I am not a CPA, I am not an attorney or a financial advisor. This is not financial advice, not telling you or anyone else what to do. The views and opinions expressed in these podcasts are provided for education and informational purposes only and are not necessarily the views of my employer. I'm glad you're here. Now let's dig in. All right, welcome back, Freedom Point Podcast listeners. Thank you again for jumping into another episode of the Freedom Point. We're so glad you're here with us again today. I've got another amazing guest with me, Justin Goodin. Justin, welcome to the show.
Yeah, thanks for having me on, Jeremy.
Yeah, happy to do it. Justin really started as a multifamily underwriter, believe it or not, and then he analyzed countless deals and saw the wealth building power of real estate. And in 2020, he left his corporate job to syndicate multifamily deals and became a general partner in 500 units. I know that you've got a lot more of a story to tell there, Justin. So we'd love for you to kind of, unpack for our listening audience a little bit more about you and maybe the journey that you've been on, what you're currently focused on today, et cetera.
Yeah, happy to do so. So like you mentioned, I'm a multifamily investor here in Indianapolis, Indiana. Actually moved into multifamily ground up development here in Indiana now. And our first project on the development side was $32 million. Our second one that we're working on right now is $26 million. So it's been an awesome year, a lot to be thankful for. But, it didn't start this way. I got started in real estate back in 2018, like most people, wanting to get some form of passive income into my life. And like most people, the first idea I get is, okay, I'll go start investing in real estate. And, also like most people, I had absolutely no idea what I was doing. But, I figured the first thing that I would do is go buy a fix and flip or a rental. And that's exactly what I did. So without knowing too much about real estate and kind of just jumping in, I bought a rental on the west side of Indianapolis for $44,000, if you can believe that. And this was a, recently renovated flip or, property for $44,000 back in 2018. So kind of, dove into the residential side without knowing anything about commercial real estate. Quickly found out that it wasn't passive, it was difficult to scale, and just had a lot of time commitments for this investment that I was trying to be passive for. So long story short, I started doing a lot of self-education about commercial real estate, working with partners, working with investors to work together and buy these larger commercial real estate assets. Got really intrigued by that part of commercial real estate, and so after I graduated from business school with a degree in finance, I started working for a multifamily for a bank as a multifamily underwriter, which was actually fantastic experience for what I do today. Seeing how banks look at properties, how they underwrite sponsors, how they evaluate risk, all of that was like really beneficial for what I do today. So fast forward, left my W-2 job to pursue real estate full time and started buying the typical existing value add multifamily properties in and around Indiana. Scaled up to around 500 multifamily units with other general partners. And about a year ago, we have transitioned fully into doing ground up multifamily development. And there's some reason for that. I'm happy to chat about that as well. But, for me and my goals and where I saw the market and what was happening, it just made a lot more sense to go into ground development. And I've been doing that for a year now and really excited about the journey.
Yeah, that makes sense. And thank you for kind of articulating your background. And I think a lot of us in the real estate space, we got started, really on the single family, side, whether that was wholesaling, fixing or flipping or building up a single family, portfolio. And interesting that you have a background in underwriting. I would say my biggest feedback that I give, to potential investors is if you can really learn and understand and be able to dance around, an underwriting model or a pro forma, you're going to be in a lot better position to be able to make an educated, decision on whether or not that investment works for you. So, when it comes to multifamily underwriting, kind of that transition from multifamily to development, what really, inspired your transition to focus on ground up projects versus acquiring, existing properties that maybe had a value add component?
Yeah, great question. And I think like the number one reason is just because of the vast amount of competition in the value add space. And if you're in real estate, you probably already know the term. Value add is pretty well known term in the industry right now. But everybody in their everybody and their brother is going after these value add properties. They're so it's a lucrative strategy. It's really competitive to go after, and there's so many investors going after the same kind of assets, which in return I just saw created a tremendous amount of competition, a lot of borrowers overpaying for properties, and it's just really tough to win a deal. And speaking on the underwriting part, I went an entire year without buying a property because I couldn't win or find a deal that made sense for the numbers that I was putting into my underwriting model. And the competition is just so vast. People are so willing to overpay for some of these properties sometimes. It just made it really difficult to find a property that, I felt confident in, one, one buying and then two, like, pitching to my investors.
Yeah, I appreciate you sharing that. And you're, exactly right. I mean, obviously we're sitting, at this point, Q1 of 2025, and still today, just over the course of the last couple of years, the only deals that we're really seeing penciling in the multifamily space are those that are being sold or transacted by severely distressed sellers, right? Why is that the case? Well, people that are hanging on to multifamily, properties today that are cash flowing, that are not operationally or financially distressed, really the seller doesn't want to sell right now in a down market. Why? Because why would you want to give the next buyer a discount, on an asset, that's currently performing well today? So I appreciate that. My next question is really kind of around, why the focus on multifamily specifically, from a ground up development perspective versus some of the other asset classes that are out there in the space today.
So I did not want to move out of the commercial multifamily, space. I wanted to stay into multifamily. And so the next best thing was multifamily development. But yeah, to answer your question, I'm just a true believer of the asset class. So I think that, multifamily is just going to continue to be in demand and for the long-term future. We all know that housing is not getting any cheaper. I think, owning a house is going to be, become more difficult for the average American to buy. And then plus, like all these, younger professionals, millennials, people getting out of college or into the workforce, I don't think, at least like in their early years, they want or are going to be able to buy a house. So I think this is going to force a lot more people to rent for the long term, which in demand, in return is going to cause multifamily to be more in demand. But yeah, to kind of piggyback off that, but people are always going to need a place to live, no matter what kind of interest rate environment in, like what kind of economy we're in. People are always going to need a place to live, and so I think it's always going to be an asset that's going to be in demand. You can't replace it. Google can't replace it, so it's always going to be a very stable, consistent asset class.
Yeah, it makes total sense. And there's obviously a severe, supply shortage, both I would say on the single family side and the multifamily spot side. So it's certainly a good, space to be in, from that perspective.
I'm Zach Haptonstall, CEO and co-founder of Rise 48 Equity. Our goal is to help you protect and grow your wealth by investing in large multifamily apartment buildings. We do all the work as far as sourcing these large apartment buildings from the brokers, doing all of the on-site management with our vertically integrated property management company, doing all the renovations with our vertically integrated construction company. We completely rebrand the exteriors. We will renovate the interiors to our full platinum level scope, which increases the value of the asset to get that profit margin for the investor. If you'd like to learn about how you can partner with us on these exciting opportunities, and go to our website and set up a call with our team.
When it comes to any type of an investment, strategy, really the investor ought to consider, what does the end point look like, right? So before I begin or before I deploy capital into a deal or before an operator decides to, build a ground up development project, we need to begin with the end in mind, right? So what does that end typically look like for your development projects?
Yeah, so at least for us, what we're doing with our business model, it is selling as quickly as possible. We're developers. That's our strong point. We are looking to build the property, lease it up, and sell it as quickly as possible. And the vast majority of investors that I have spoken to, at least like in my network, the cash flow is nice, but I think it's better for investors to have, multiplying their equity as quickly as possible. So at least like the investors that I have talked to, the cash flow is nice, but they're not really too overly concerned about earning, 4 or 5% on a coupon and cash flow every year. It's much more lucrative and favorable for these investors to multiply their equity as quickly as possible. And as you know, the majority of the profits come from a sale. So yeah, to answer your question, we're looking to build, lease up, and sell. Not looking to hold these properties long term or asset manage them. Just looking to get in and out and multiply our equity as quickly as possible.
Yeah, makes sense, Justin. I'm currently invested in a few different build to rent type opportunities, as of today, and I know that the story is not always roses, right? So, what are some of the biggest challenges that you face, in the ground up development, space, and how does your team overcome them?
So yeah, it's definitely costs, it's interest rates, it's all those things combined. It makes it makes projects difficult to get the pencil out. But we have actually a competitive advantage that not a whole lot of developers partake in, and that's partnering with different municipalities to build our projects. Which as I just mentioned, interest rates are tough, costs can be tough to get a deal to pencil out. So the way we combat that and stay active, even in a slow market or down economy, we can still continue doing deals and doing projects when we partner with a different city or town to get them to partner with our project. Basically, with how costs are, with how interest rates are, it's extremely difficult, if not impossible, to get a brand new Class A property to pencil out on paper unless there's some form of municipal incentive involved. And what that does is it makes the project financially feasible for us as a developer. So this isn't like a developer's coming in and taking advantage of the situation or getting like this free money from the city. Like we're partnering with these municipalities to build a quality project, which is in turn, providing quality housing to the area, is creating jobs, is bringing businesses into the area. So it's a win-win for both sides and a competitive advantage that we have that not all developers partake in.
Yeah, thank you for sharing that. I also know that, it's all about location, 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 right? Everybody's been hearing that, since maybe high school or college business courses, right? So, what steps do you identify, to be the best locations for your development projects?
Yeah, great question. And that's a fantastic point. We're looking to build the best quality projects in the best locations. Location is absolutely number one. It doesn't matter, about the project or the market. Like it has to be in an awesome location and an awesome market for us to, want to build that. So for us, yeah, we're looking at, population growth, business or employment growth. We want to see, businesses and people coming into that area. Also, we want to stick to like landlord and business friendly areas, and most of all, we want to stick to like supply constrained markets. So we're building a project in Indiana right now in a smaller market outside of Indianapolis, about 30 minutes away from Indianapolis. And right now, there's only one other A class property in this entire city, which is amazing for us as a developer. The last A class property that was built in this city was way back in 2017. So the city just announced recently like 3,000 new jobs to this city. So obviously, like a very supply constrained market. We just think this project is going to be a home run, just simply because it's really supply strained, and there's not a whole lot of places to rent right now in that city.
Yeah, makes sense. Now, my listening audience has heard me say this a number of different times, and that is when it comes to real estate, birds fly, fish swim, and real estate falls apart. So my question for you is this, and that is, I know things aren't always rosy, in the space. How do you then thus, really communicate in a transparent way so that your investors feel informed and secure, throughout the investment hold period?
So I'm a huge fan of just always telling investors the good, the bad, the ugly. I think about like if I was investing into a project, like what would I want to know? I don't want to know every time a light bulb is replaced or every time there's like trash on the ground or something like that, but I want to know like the significant items, like what actually went wrong, what's going well. If something did go wrong, like what are you guys doing to fix it or mitigate it? So I'm just really open and transparent with all my investors in a way that, if I was investing in a project, I tell them what I would want to know. So that's like always the approach that I've always had. Just tell investors the good, the bad, the ugly. And I find that just, the more transparent you are, the more, happy investors you'll have.
Yeah, it makes sense. I'm a really big fan of diversification, when it comes to Wall Street versus Main Street type investing, right? Being a limited partner investor now in, 33 different opportunities, from anything from, multifamily, ground up to, existing value add to assisted living to flex office, self-storage, industrial, retail, et cetera, et cetera. What would you say is the type of investor that is a good fit for development projects versus existing multifamily syndications?
Yeah. So I would say it's an investor that doesn't necessarily, want or need cash flow right away. Because obviously with a ground up development, there's no cash flow in the beginning while we're going through the construction process and building the project. So an investor that, doesn't want or need that cash flow along the way, but they're more interested in just a short-term hold and multiplying their equity faster. That would be like the ideal type of investor that would invest in a ground up multifamily project.
Okay, that makes sense. Now, I know that in real estate, traditionally speaking, again, depending upon operator, location, business plan, et cetera, that time usually heals almost all wounds, but not quite all of them, right? What are some of the major headwinds that you're seeing right now, in really, I'd say the commercial real estate space, specifically centered around the multifamily space in general?
We kind of touched on it already, but the distress that I've heard just from other projects that have been bought in the previous years with floating interest rate debt and valuations have dropped, rent growth has slowed down. So there's some, different headwinds that I've heard about. Really, we haven't experienced that over here. Every property that I've always invested in or have in my portfolio now has a fixed interest rate debt. So while the interest rate environment has made new acquisitions more difficult to pencil out, it hasn't affected our current projects or portfolio whatsoever because we fixed rate debt on everything we have in our portfolio.
Are these typically 5, 10-year Fannie Freddie type debt products that you're securing?
Local bank financing for the most part.
Okay. And what are there ever scenarios that you would envision where you would offload that asset prior to its loan maturity?
Yeah, I mean we're always open to selling for a price that makes sense for our investors and generating those returns. So yeah, if it makes sense to sell, then we're definitely sellers.
Are there ever scenarios in which you would envision there being any type of a yield maintenance or defeasance, in the event that you are not able to or you don't choose to, have that loan through the maturity date?
Yeah, so if we went into like a longer term Fannie Freddie product, then yes, that would come with a prepay penalty or some kind of yield maintenance. We haven't yet done that. So what we do with our construction properties is we go to a local bank for financing. They give us a 5-year term for our construction loan. So we can stay in that loan for 5 years. We could refinance out once the property gets stabilized. So we have like more than one kind of exit scenario, if you can say that. But that flexibility with the construction loan allows us to sell without any kind of a prepayment penalty, at least like within the 5 years that we stay in that loan.
Yeah, that makes sense. Thanks for helping us unpack that a little bit. I'd like to talk a little bit about kind of that new investor, right? That busy professional that learns about passive real estate investing through syndication because they follow somebody on LinkedIn that's talking about how exciting it is for the potential of being financially free or financially independent, which we see a lot of times out there on LinkedIn. What advice would you give to that individual when it comes to exploring passive real estate investing for the first time?
Oh yeah, great question. So for a newer passive investor, I mean, the first thing that I'd recommend is like not rushing into anything. There's always going to be another deal that comes by. I'd recommend like just doing your homework up front and not like rushing into anything. Two, like always asking the sponsor about the current properties in their portfolio. So you can go to the LinkedIn, you can look on their website. They have all these, flashy unit count numbers, all these nice looking pictures of properties, but you want to know like how those properties are performing today. Like it's awesome they have 5,000 units, but how are those 5,000 units performing now? Are you guys doing capital calls on any properties in your portfolio? Is there any loan maturing in the near future? Are you hitting your projections in those properties? So don't always go after like or go off of how many followers they have, how fancy their website looks. Like actually ask the sponsor like how are your deals performing compared to when you originally underwrote the deal, and do your homework that way. Third, you can also do a background check, which is something I don't like hear a lot of people talk about. But a background check is very simple and easy to do. And if the sponsor is willing to lie about something minor or an educational degree, I mean, you don't know what they're going to do with your money. So obviously, a background check is very simple, very easy to do. And I mean, fourth thing I'll add is just like ask, open-ended questions to that sponsor. So when you meet with them in person or on a Zoom call, actually like ask them open-ended questions and just try to get a feel for like how they're answering. Are they giving you like very short to the like very like short and sweet answers? Are they elaborating a lot? Do you feel like they're kind of just like brushing you off? Do they sound like educated in that topic you're asking them? So, just kind of like ask them open-ended questions, get a glimpse of how they respond to you like that.
Yeah, I so appreciate that. And I also appreciate when I speak to operators that are overly transparent as well. I have the pleasure or luxury of looking at a lot of different investment, projects every single week and deciding whether or not A, I'm going to invest my own capital into that deal, and B, I'm going to partner with other investors in my network to do the same. And the challenge that I see out there in the space today is as it relates to the track record. So there's one side of the coin is that maybe the sponsor got lucky in terms of transacting deals where they were purchasing when the market was down and selling when the market was up. But I specifically want to hone in on those deals that were transacted on the buy side in 2021 and 2022 when everybody was running into the fire when they should have been running out of the fire. And if the sponsor's not willing to put those deals on their track record, I would say that's a cause for concern for me when a sponsor is being selective in terms of what deals they're communicating on their pitch deck, as it relates to their track record. Does that resonate with you?
Agree. Totally agree. Yeah. I'd also add, yeah, Jeremy, I'll add one more thing, but it's, kind of like you mentioned, but it all comes down to the numbers. Did they sell this property back in 2021 when interest rates were 3%, and therefore it's still a win, but just something to be cognizant of. It's really a lot more difficult to sell properties and go full cycle, at least with the numbers you're projecting in a down market or when interest rates are higher. But yeah, I mean, it all comes down to the numbers. So if you can ask the sponsor for like real credible case studies that show their original underwriting compared to their actual numbers of what actually happened, that can give you a glimpse of how accurate they are in their underwriting, like how conservative they are. Whatever you can do, whatever you can do to actually verify these numbers. There's a good saying out there like trust, but always verify.
Yeah, makes sense. Good. Well, what's next for Goodin Development as we move into 2025 and beyond?
Yeah, so I'm just a huge fan of staying laser focused. So for us, that's building Class A mixed use properties here in Indiana. Like we're not looking to go in Ohio, Florida, Texas, wherever. Like I'm only doing one thing, and that's building Class A multifamily in Indiana. So at least like for the foreseeable future, we'll be doing projects here in Indiana. After 3 to 5 years, we're going to explore bringing more businesses in house. So we'll explore going in house with our construction company, in house with our property management company. But again, like for the foreseeable future, all I plan on doing is just developing the same kind of product here in Indiana.
That makes sense. Yep, sticking to your buy box. Justin, I really appreciate the time that you've been able to spend on our episode today.
Yeah, thanks for having me, Jeremy. Really appreciate it.
Absolutely. What would be maybe one or two different ways that our listening audience can connect with you to learn more about what you're up to?
Yeah, they can find me on LinkedIn, just my first and last name, Justin Goodin, or on my website. You can take my my free 7-day passive investing 101 email course. If you just go to goodindevelopment.com/course, it's a free 7-day email course for them to partake in.
Great. Well, we'll definitely put those links in the show notes for the episode. Again, Justin, thanks for your time today.
Thanks, Jeremy.
Absolutely. And listening audience, thank you again for jumping into another episode of The Freedom Point. We look forward to having you join us on the next episode.
Thank you for hanging out with us today and for listening to the Freedom Point podcast, powered by Starting Point Capital. This show is for entertainment purposes only. Nothing said on this show should be considered financial advice. Before making any financial decision, please consult with a professional. This show is copyrighted by the Freedom Point podcast. Written permissions must be granted before syndication or rebroadcasting. If you're interested in connecting, you can find contact information at startingpointcapital.com.